Hey y'all, Brandon Snyder with Selling with the Snyder Group here, Real Relationships, Real Estate. And today, a week before Christmas, I have some news that you probably want to hear about. Before we get started, if you'll like, subscribe, and comment below, that helps us keep going and producing content relative to the Houston real estate industry and also the United States as well. So, our good old friends at the Federal Reserve, if you are like me, you probably don't know a lot about what they do up until recently. They're in charge of all the money circulating and all the loans and the debt that the United States accumulates and how our economy works with that. They came out in September and said, we're probably going to see one rate hike next year. Now, I just started learning about the Federal Reserve. They're in charge of bonds, short-term loans, things like that, and they're in charge of the interest rates. So in September, they came out and said, hey, we're probably going to see one hike next year, which we were all expecting. We've been seeing a slow rise in interest rates. Longer the days gone of 2.5% on an FHA loan, 2.75. We're still seeing that here and there with immaculate credit, no debt, things like that. But the Federal Reserve came out a couple days ago and said, hey, we were a little wrong. We're going to adjust our prediction. We're going to probably see 3 rate hikes this next year. Now, why is that a big deal? A lot of you are probably like, well, Brandon, I don't understand what the Federal Reserve and short-term loans and bonds have anything to do with the housing market. Well, everything that the Federal Reserve does and the government programs that are behind that, we're talking FHA loans, any government-backed loan, all of those are trickled down and the interest rates are affected by all of those programs and processes. So the Federal Reserve came out and said, hey, we think we're going to see 3 rate hikes this next year. That is important because we've been seeing sub 3% interest rates since the pandemic started. Now, I don't know about y'all. I took advantage of it. I bought a house at 2.875 and it's been absolutely awesome. Now, if I had bought at 3.5, maybe high 3s, probably wouldn't have been able to comfortably afford the payment that I wanted to be in this house. So, as interest rates continue to go up, which we're seeing, they're gradually going up, what the feds are coming out and saying is that we're probably going to see 3 hikes. Now, that's not just gradual change. That's, hey, this is happening. So, what does that mean for you as a home buyer? Let's talk about this. 3 things you need to be doing right now. I know it's Christmas. I know we're spending money on family, loved ones, kids, things like that. But if the Federal Reserve is going to bring interest rates even higher than they are now, you need to be saving money. You need to be saving money to put towards down payment if you plan on buying a house in the future. The difference between a 3% interest rate and a 3.5 or potentially 4% interest rate can be hundreds of dollars a month in payments. So in order to counteract that, you need to be saving money to put more money down on your home. A lot of people have taken advantage of the 3.5% down by the FHA this past year and a half, 2 years, and it's been great. They've gotten the payments they wanted. But as the interest rates go up, we want to make sure that we're counteracting the payments with that down payment. Because at some point, with the interest rates getting higher and higher, they're going to price people out of the market. And there's still no rental properties available, and apartments are pretty scarce. So you're seeing that there's going to be a supply issue still, but people are still going to be priced out of the market. So first thing you need to do is be saving money. Second thing we need to be doing is if you're contemplating a move in the next 6 to 9 months, you need to see what you can do to move that timeline up to potentially 3 months. You need to talk to a mortgage professional. You need to talk to a real estate agent about what can you do to get in a house in the next 3, potentially to 6 months. It's important to understand exactly where you stand because you could potentially get priced out of the market in 6 months. Now, this isn't just through interest rate. This is through appreciation as well. Your average home in the United States has a natural appreciation of 3 to 5%. Homes right now, due to the pandemic and the housing market being what it is even higher. We're seeing 10, 15, 20%. Absolutely crazy numbers. That's insane. So if you're going to take advantage of low interest rates, you're going to take advantage of, a job, things like that that are making your living situation better so you can afford a home, you need to talk to a mortgage advisor and a realtor about what your options are in the next 3 to 6 months. Because if that hike happens in the next 3 to 6 months and you haven't game planned for it, then you're going to be priced out of the home you want. And then the natural appreciation is going to take over on these homes in the next, couple of years, and then you're going to really be priced out of the home you want instead of gaining equity in the home you love. All right? The third thing, and the last thing we're going to talk about here, is if you are worried about your credit, you need to work on that. Some people get kind of anxiety ridden. I'm one of them. I hired a company to take care of my credit issues, and I was able to get a house at a favorable interest rate with a 640 credit score. That's all it takes, y'all. Now, I say this not to be down on you, but I want to explain to you that it's important that you know where you're at with your credit and where you're at with your debts, and there's options for you to get that cleaned up. But if you don't talk to a mortgage advisor, you don't have a game plan. If you don't talk to a realtor, you don't have a game plan. You need to be doing these things to get ahead of the curve. Because what's going to happen is rates will go up. Home prices will get even higher. The average home price in Houston is low 300s right now. Okay? That will continue to go up every single year. So, this is what I would recommend. Go educate yourselves on what your game plans are to be buying a house in the next 6 months or so, because rates will go up. So make sure you're saving money. Make sure you're talking to a mortgage advisor, and make sure you're working on your credit score and debt. If you're looking for content like this, whether it's financial, real estate related, in the Houston area, or you're looking across the U.S. to look at homes or sell a home, please contact us. We'd love to be able to help you. Selling with Snyder Group is a full-service real estate team in the greater Houston area, and we are at your service. If you like this content, please like and subscribe. It helps us greatly, keeps our content flowing. Y'all have a blessed week and a Merry Christmas.